While the world screams about AI, a $2.5 trillion ghost ship has quietly swallowed an entire G7 nation's economy. It's Wall Street's most successful secret, a silent monster growing in the shadows of your portfolio. The music is playing, but there are no lifeboats. Wall Street is a cathedral of noise, a place where interns bleed their youth away chasing validation from ghosts who don't even know their names. We've been conditioned to watch the flashing lights, the manic swings of Bitcoin, the messianic promises of AI. But while the world was shouting, I noticed a terrifying silence in the shadows of the trillion-dollar funds. They've moved their chips to a corner of finance so profoundly dull it almost feels like a camouflage designed to keep us away. It's called private credit. I spent 2 months exhuming the digital records of this industry because the scale of it made my blood run cold. We are looking at a $2.5 trillion juggernaut that has quietly ballooned until it is officially larger than the entire GDP of Canada. Think about that. An entire G7 nation, outweighed by an invisible ghost ship. I had to know why the smartest people in the room are betting everything on the boring math of shadow banking. This is the story of the money machine no one talks about. If you want to see the invisible strings before they snap, subscribe to the channel now and join me on this investigation. To truly grasp how this shadow juggernaut was allowed to grow in the first place, we have to travel back to the smoldering wreckage of 2008, the year the world's financial heart briefly stopped beating. I've always found it hauntingly ironic that the very laws designed to save us from our own greed are the ones that paved the way for this invisible empire. Before the crash, the atmosphere on Wall Street was pure, unadulterated madness. We saw banks handing out those infamous ninja loans, no income, no job, no assets, like they were handing out flyers on a street corner. It was a hallucinatory era where Banker Tucker would dap you up and wire you cash for a failed vape shop without blinking. They took those steaming piles of debt, bundled them into toxic puzzles called CDOs, and sold them to the world as if they were solid gold. When the house of cards finally collapsed, it wasn't just a correction. It was a near-death experience for global capitalism that left a permanent scar on the collective psyche. In the chaotic aftermath, the regulators stepped in to play the responsible adult. They rolled out a massive, suffocating rulebook that essentially turned banks into strict, paranoid parents. These new laws forced banks to increase capital reserves, cut leverage, and tighten their lending standards to an extreme. Suddenly, lending to small and medium-sized companies, the backbone of the American economy, wasn't worth the regulatory headache anymore. Traditional banks essentially ghosted the middle market, leaving thousands of businesses stranded in a desert without a drop of liquidity. This is the moment I want you to see clearly: the big bang of private credit. It wasn't born out of a brilliant new invention. It was born out of a vacuum. While the government was busy shackling the banks to keep them from burning the house down again, they accidentally left the back door wide open. Firms like Blackstone and Ares weren't just watching, they were waiting. They realized that if the banks were no longer allowed to be the lenders of last resort, they could step into that void and become the masters of the shadows. This wasn't just a shift in business. It was a tectonic migration of power that changed the face of Wall Street forever. Once the banks were safely locked in their regulatory cages, a massive silent void opened up in the heart of the American economy. It's a phenomenon that reminds me of the most brutal rule in finance. If there is a hole in the market, someone, somewhere will find a way to fill it. We're talking about the middle market companies, businesses that are the lifeblood of our infrastructure, but found themselves in a terrifying purgatory. They were too massive for your friendly neighborhood credit union, yet not quite glamorous enough to issue high-yield bonds on the public stage of Wall Street. They were essentially ghosted by the only system they ever knew. And that's when the sketchy uncle of private credit stepped out of the shadows with a roll of cash and a smirk. I find it absolutely mesmerizing how quickly this turned from a niche rescue mission into a full-blown financial takeover. These private funds didn't just offer loans, they offered speed and secrecy. They told desperate CEOs, forget the collateral, Forget the 50-page bank forms. Just sign here, pay us 10%, and we'll wire the money before the sun goes down. It was a pitch that worked better than anyone could have predicted. Companies started lining up with a frenzy I can only compare to a Black Friday sale at Lululemon. By 2010, we were looking at $300 billion in assets. By 2020, it shattered the trillion-dollar ceiling. Since the crash, this industry hasn't just grown, it has undergone a 1,000% explosion. It's no longer just a backup plan. It's a $2.5 trillion juggernaut that functions like a high-stakes Venmo for billionaires, wiring $200 million at a time to refineries and factories while the rest of us are still checking our savings accounts. It's a tectonic shift that proves the old way of banking isn't just dying. It has been replaced by a ghost. If the sheer scale of this industry represents the body of the monster, then the math behind it is the heartbeat. And it's a beat that has every major investor on the planet dancing to its tune. I've spent countless hours staring at the performance charts, and on the surface, the numbers don't seem to add up. Over the last 20 years, private credit has returned about 9.6% annually, while the S&P 500 has churned out roughly 10.2%. In the competitive arena of high finance, giving up 60 basis points feels like a cardinal sin. But here is the secret I've uncovered. Wall Street isn't actually chasing the highest peak. They are chasing the flattest line. They call it the Goldilocks asset for a reason. It's too risky for the handcuffed banks, too safe for the wild hedge funds, and just right for the people managing $30 trillion in pension funds and endowments. I want you to think about the psychological toll of the public markets. We live in a world where the entire stock market can suffer a massive heart attack just because Jerome Powell clears his throat during a press conference or a single headline drops on social media. Stocks are a relentless emotional roller coaster, a moody partner that can swing 20% in a week. Private credit, however, feels like a sanctuary. Because these are private, bilateral contracts, they don't fluctuate every second on a glowing red screen. They are smooth, boring, and consistent. For an institutional investor trying to pay out retirees 20 years from now, that 60 basis point sacrifice is a small price to pay for the privilege of a good night's sleep. They've traded the adrenaline of the chase for the comfort of a guaranteed, flatlined reality. And in a world as chaotic as ours, boring has become the most expensive and sought-after commodity in existence. But as I sit here staring at this sanctuary of stable returns, I can't help but wonder if we've actually made the world safer, or if we've just become exceptionally good at hiding the smoke until the entire building is already on fire. This is the part of the investigation where the magic of Wall Street starts to feel a lot more like a haunting mirage. You see, the very thing that makes private credit so seductive, its lack of public volatility, is exactly what makes it so potentially lethal. Because there is no centralized exchange and no glowing ticker tape, these loans are valued through a process called mark-to-market, which in the shadow banking world, I've realized, is often just a fancy term for a high-stakes guessing game. Nobody actually knows what these billions of dollars in loans are truly worth until a borrower stops paying. And by then, the autopsy has already begun. We are looking at a $2.5 trillion industry built on the massive, singular assumption that the music will never stop and the interest payments will always roll in. But unlike the stock market where you can cut your losses with the click of a button, here you are locked in the room. There is no emergency exit. We've traded transparency for the illusion of safety, and as I look closer, I see the cracks in the porcelain starting to widen. Is this a genuine financial revolution, or is it just the same old bubble wearing a more expensive suit? The truth is, Wall Street is getting richer, regardless of the outcome, but we have to be the ones brave enough to ask, what happens to the rest of us when the lights finally come on and the silence is broken?